SPCX did not just go public. It turned one of the most famous private companies in the world into a public market scoreboard. By the close, SPCX was not just an IPO anymore. It had become a $2 trillion volatility machine. It opened near $150. It ran as high as the mid-170s. Then it settled near $161. So yes, demand was real. But the first lesson is also real. Access is not the same thing as margin of safety. For years, investors could argue about SpaceX from the outside. They could talk about rockets. They could talk about Starlink. They could talk about Elon Musk. They could talk about Mars. They could talk about whether SpaceX was really a space company, an internet company, a defense contractor, an AI infrastructure company, or some impossible combination of all of them. But today, that story has a ticker. And once a company has a ticker, mythology has to sit next to a quote screen. That is why this IPO matters. Not because the first day price action tells us the whole truth. It does not. Not because the company is suddenly easy to value. It is not. And not because every rumor around the IPO is true. Most of them are not. This video is about separating the three things that are getting mixed together today: the business, the hype, and the proof. Well, I will show you 5 things: what SpaceX actually owns, why Starlink is the real engine, why AI could be either genius or dangerous, why QQQ rumors are not day one facts, and what proof must show up before this becomes a great stock, not just a great company. Because SPCX is not a normal IPO. The final prospectus says SpaceX offered 555,555 Class A shares at $135 per share. That is roughly $75 billion of gross IPO proceeds before the underwriter option. The company expects about $74.4 billion of net proceeds before the option, and about $85.7 billion if the underwriters exercise the option in full. That is not normal large. That is record book large, and this is why people are calling it the biggest IPO ever. The prospectus math alone gives you the reason: $75 billion of gross proceeds before the underwriter option. That is far above the old global IPO benchmarks investors usually compare against. So if the headline is record-breaking IPO, that is not just internet hype. The offering size really is extraordinary. And on the first trading day, the market did what markets often do with a story this big. It tried to price the dream before the first quarterly report as a public company. At the June 12th quote snapshot used for this script, SPCX opened near $150, hit an intraday high around $176, and then finished near $161. Volume was enormous, roughly 500 million shares plus. So the first day story has 2 parts. Access demand was huge, but the stock also faded hard from the high. That matters because it reminds investors that first day demand can be real while first day price discovery is still unstable. On roughly 13.08 billion shares outstanding, that implied a market capitalization a little above $2 trillion. That number can move by the time you watch this, but the point is already clear. The market is not treating SPCX like a small speculative space company. The market is treating SPCX like a mega cap platform company on day one. One Reuters Breaking Views frame put the opening valuation at roughly 105 times 2025 revenue. That is the valuation shock in plain English. This is not just normal expensive. This is dream priced upfront expensive. So the question is not, is SpaceX important? Of course it is important. The better question is, at a public market valuation this large, what has already been proved, what is still hype, and what has to show up next for shareholders to win? That is the whole video. This is not financial advice. I am not telling you to buy or sell SPCX. I am explaining how I would read the IPO, the filing, the valuation, the QQQ rumor, the Fidelity and 401k rumor, the political angle, and the actual business underneath the noise. And here's the thesis up front. SPCX is not one story, it is 4 stories stacked on top of each other. First, it is a launch company with a real cost and cadence advantage. Second, it is a satellite internet company where Starlink is already producing serious revenue and segment profit. Third, it is a government and national security infrastructure company, even if people do not like using that phrase. Fourth, after the XAI combination, it is also an AI infrastructure story with huge ambition, huge capex, and huge uncertainty. The bull case is that those 4 stories reinforce each other. Cheap launch makes Starlink possible. Starlink creates cash flow and global distribution. Government demand creates strategic durability. AI infrastructure creates a new upside layer. And if Starship works at scale, SpaceX can keep lowering the cost curve while other companies are still trying to catch up. That is the dream. The bear case is that investors are paying for too much of that dream on day one. The company is losing billions. Capital expenditures are enormous. AI is still early and very expensive. Starship remains a critical execution risk. Public shareholders get Class A stock with 1 vote per share, while Class B has 10 votes per share. And Elon Musk is expected to control more than 80% of the voting power immediately after the offering. That means public investors may get exposure. They do not get control. So do not reduce this IPO to one sentence. Do not say it is SpaceX, so it wins. And do not say it is expensive, so it fails. Both are too lazy. The real question is whether the company can turn strategic importance into per share economics at a valuation that already assumes extraordinary execution. Start with what actually happened today. Space Exploration Technologies Corp. sold Class A common stock to the public under the ticker SPCX. The IPO price was $135 per share. The number of shares offered by the company was 555.6 million shares. Multiply those together and you get about $75 billion of gross offering size. After the offering, the prospectus says the company will have about 7.38 billion Class A shares outstanding and about 5.70 billion Class B shares outstanding before the underwriter option. Put those together and you get about 13.08 billion shares outstanding. That is why the first day quote screen can show a $2 trillion market cap if the stock trades around $160. The math is not mysterious. The market cap is the share price multiplied by the share count. What is easy to miss is the float. The IPO sold about 555.6 million shares into the public market, while the total share count is more than 13 billion. That means the first day tradable supply is small relative to the full company. Small float plus massive brand recognition plus retail access plus institutional FOMO can create violent first day price action. That does not prove the long-term value. It proves demand for access. Those are different things. This is one reason the price can move so much before the first real post-IPO earnings report. The market is trying to digest a huge company through a limited public float. The prospectus also says the underwriters have an option to buy up to an additional 83.3 million shares for 30 days. If that option is exercised in full, SpaceX gets more proceeds and the public float expands. But even then, this is still a public float story inside a much larger controlled company structure. There is another unusual access point. Reuters reported that SpaceX set aside 30% of the offering for retail buyers. For a deal this large, that matters. It means the IPO was not only an institutional allocation event, it was also deliberately open to a wide retail audience through online brokerage channels. That helps explain why the hype felt organic and engineered at the same time. Organic because retail demand for SpaceX has existed for years. Engineered because the deal structure gave that demand a direct access point on IPO day. That matters because first day demand is not the same thing as long-term ownership economics. If you remember nothing else from the IPO mechanics section, remember this: the stock can be liquid and still not give outside shareholders much control. Class A gets 1 vote per share, Class B gets 10 votes per share. The final prospectus says Elon Musk is expected to hold about 82.4% of the voting power immediately after the offering. Voting control is not the same thing as economic ownership. That distinction matters. Musk can have overwhelming voting control without owning 82% of the economics because Class B shares carry 10 votes per share. The company expects to be a controlled company under NASDAQ and NASDAQ Texas rules. So this is not a normal shareholder democracy. It is a controlled founder-led public company. That can be good if the founder keeps executing. It can be painful if outside shareholders want a different direction. Either way, it is not a footnote. It is part of the security you are buying. Now, why is the hype so extreme? The simple answer is SpaceX. The better answer is scarcity. For years, many investors wanted exposure to SpaceX and could not get it directly. They could buy public aerospace companies. They could buy satellite companies. They could buy telecom companies. They could buy Tesla if they wanted Elon-related exposure. They could buy funds that might hold private shares, but they could not simply open a brokerage account and buy SpaceX common stock. Now they can buy SPCX. That change creates a one-time emotional event. The company did not just sell shares, it sold access to a story people have been locked out of for years. That is why this IPO has a different texture from a normal software IPO. There is financial hype, but there is also cultural hype. Some people see rockets landing on drone ships. Some people see Starlink dishes on houses, boats, aircraft, military assets, and remote communities. Some people see a future Mars economy. Some people see satellite to mobile connectivity. Some people see a new national champion in space. Some people see Elon Musk. Some people see AI compute in orbit. And some people see a ticker that could eventually enter major indexes. All of those stories are now compressed into one symbol. That is powerful. It is also dangerous. When one ticker carries too many dreams, investors can stop asking which dream actually funds the business. So let us separate the company into its actual operating buckets. The final prospectus gives us 3 major segments: space, connectivity, AI. Think of them this way. Space is the engine. Connectivity is the cash machine. AI is the expensive option. The space segment includes launch services and the launch infrastructure that supports the rest of the company. The connectivity segment is primarily Starlink. The AI segment comes from the XAI combination and includes AI products, compute infrastructure, and related services. That structure matters because when people say SpaceX, they often picture rockets. But the strongest financial engine in the filing is not the rocket business by itself, it is Starlink. In 2025, SpaceX generated $18.7 billion of consolidated revenue. It had a loss from operations of about $2.6 billion. It had a net loss of about $4.9 billion. And it reported adjusted EBITDA of about $6.6 billion. That is the first contradiction. This is not vaporware. The revenue scale is real. The operating cash flow is real. The company reported about $6.8 billion of net cash provided by operating activities in 2025. But it also spent about $20.7 billion on capital expenditures that year. So the company is not small. It is not fake. It is not pre-revenue. But it is also not a clean, mature cash compounding machine yet. It is a giant investment machine. That is the financial personality of SPCX. Revenue is real, strategic value is real, but the capital demands are also real. Now look at the first quarter of 2026. The company generated about $4.7 billion of revenue. It had a loss from operations of about $1.9 billion. It had a net loss of about $4.3 billion. It produced about $1.1 billion of adjusted EBITDA. It generated about $1.0 billion of operating cash flow. But capital expenditures were about $10.1 billion in just that quarter. That is the number I would underline, $10 billion of CapEx in one quarter. That is why this IPO is not only about giving old investors liquidity. The company is raising a massive amount of capital because its ambition is massive and its spending is massive. Now break it down by segment. Start with connectivity, because this is where the business looks most like a real scaled platform today. Connectivity generated about $11.4 billion of revenue in 2025. It produced about $4.4 billion of income from operations. It produced about $7.2 billion of segment adjusted EBITDA. And as of March 31st, 2026, Starlink had about 10.3 million subscribers across 164 countries, territories, and other markets. The company also had about 9,600 Starlink broadband and mobile satellites in low Earth orbit. That is the strongest financial evidence in the whole filing. If you want the cleanest bull case, it starts with Starlink. Starlink is not a PowerPoint idea. It has subscribers, it has global coverage, it has revenue, it has segment profit. It benefits from SpaceX's launch advantage, and it gives SpaceX something that most space companies do not have, a recurring customer relationship. Launch is episodic, connectivity is ongoing. That is why Starlink changes the story. But Starlink is not perfect. And the filing shows Starlink subscriber ARPU was $66 per month in the first quarter of 2026, down from $86 in the first quarter of 2025. That does not kill the bull case, but it changes the question. Subscriber growth is strong. The average revenue per subscriber is falling. That can happen when a company expands internationally, offers different price tiers, sells into lower income markets, or changes mix across consumer, enterprise, mobile, and government customers. The investor question is not just, are subscribers growing? The better question is, can Starlink keep growing subscribers while protecting margin and avoiding a race to lower ARPU? That is a proof gate. Now move to space. This is the part everyone understands emotionally. Rockets, reusable boosters, launch cadence, Falcon, Starship, NASA missions, national security space launch missions. The prospectus says Falcon 9 had completed about 620 orbital space launches as of March 31st, 2026, with an over 99% mission success rate. It also says SpaceX was the primary launch provider for the U.S. government in 2025. In that year, it launched 11 of 12 national security space launch medium and heavy lift missions, and all 5 U.S. crew and cargo missions to the International Space Station for NASA. That is why the political angle is real, not conspiracy. Real. SpaceX is not just another commercial company selling an app. It sits inside U.S. space infrastructure, national security launch capacity, NASA crew and cargo missions, FCC spectrum policy, FAA launch approvals, defense procurement, and geopolitical communications questions. That can make the company strategically durable. It can also make it politically exposed. In 2025, the space segment generated about $4.1 billion of revenue. It had a loss from operations of about $657 million. It generated about $653 million of segment adjusted EBITDA. The prospectus also says the space segment funded about $3.0 billion of research and development expense in 2025 for Starship. In the first quarter of 2026, the space segment generated about $619 million of revenue and had a loss from operations of about $662 million. That looks weak if you only look at the segment income statement. But the filing explains why the space segment is tricky to evaluate. SpaceX uses a lot of its launch capacity internally for Starlink and expects to allocate launch capacity to AI in the future. For launches dedicated to deploying Starlink satellites, the company generally capitalizes the associated costs inside connectivity instead of recognizing revenue in the space segment. So the space segment financials do not fully capture the strategic value of the launch machine. This is one of the most important investor lessons in the whole video. The rocket business may look smaller than its importance. Launch is not just a revenue line, it is the cost advantage that enables the other revenue lines. If Falcon and Starship let SpaceX deploy satellites faster and cheaper than competitors, then the moat shows up in Starlink economics, AI orbital compute economics, and government reliability, not only in third-party launch revenue, but that same logic creates the biggest execution risk. Starship has to work. The prospectus is direct about this. Failure or delay in developing Starship at scale, or failing to reach required launch cadence, reusability, and capability, could delay next-generation satellites, global satellite-to-mobile connectivity, and orbital AI compute. That is not a minor risk. That is the bridge between today's company and the trillion-dollar dream. Now, we need to talk about the part of the prospectus that is stranger than the rocket story, AI. A lot of investors came into this IPO thinking they were buying SpaceX. The filing says they are also buying the XAI combination. That means SPCX is not only a space and connectivity story, it is also a frontier AI story. And this is where the numbers get very intense. In 2025, the AI segment generated about $3.2 billion of revenue. It lost about $6.4 billion from operations. It had negative segment adjusted EBITDA of about $1.2 billion, and AI capital expenditures were about $12.7 billion. In the first quarter of 2026, AI generated about $818 million of revenue. It lost about $2.5 billion from operations. It had negative segment adjusted EBITDA of about $609 million, and AI capital expenditures were about $7.7 billion in one quarter. That is not a side project. That is the biggest CapEx pressure in the company right now. The filing also says SpaceX expects to begin deploying orbital AI compute satellites as early as 2028. Separately, Reuters reported that investor presentations pointed to initial orbital AI computing demonstrations by late 2027. That distinction matters. A demo is not the same as commercial deployment, and commercial deployment is not the same as profitable scale. So even if a late 2027 demonstration happens, investors still need to ask what it proves. Does it prove power, thermal management, networking, launch economics, reliability, customer demand, and revenue? Or does it only prove that the concept can be tested? For the stock, a demo is a catalyst. It is not the full business model. It describes potentially massive AI compute satellite constellations, using Starlink for low latency global connectivity. This is the type of sentence that can send a stock into mythology. Orbital AI compute, solar energy in space, millions of satellites, global intelligence infrastructure. It is an incredible story, but an investor has to separate three layers. Layer one is current AI revenue that exists. Layer two is current AI capex and losses. Those also exist. Layer three is future orbital AI compute at scale. That is not proved yet. Treat it as an option. Do not treat it as base case cash flow. The most important AI contracts in the filings are the Anthropic and Google compute agreements. The prospectus says SpaceX entered into cloud services agreements with Anthropic for compute capacity across Colossus and Colossus II. The capacity includes roughly 325,000 NVIDIA GPUs, hyperscale class CPUs, exabyte scale storage, and high-speed networking. The customer agreed to pay $1.25 billion per month through May 2029, with ramped fees in May and June 2026. That is enormous. But the agreement can be terminated by either party after the initial 3-month period with 90 days notice. So the script cannot treat it like a guaranteed forever annuity. It is a major proof point. It is also a contract that investors need to watch carefully. But Anthropic is not the only compute customer proof point. In a June 5th free writing prospectus filed with the SEC, SpaceX also disclosed a cloud services agreement with Google. Under that agreement, Google agreed to pay $920 million per month from October 2026 through June 2029, with capacity ramping from June through September 2026 at reduced fees. The filing says the capacity is expected to include about 110,000 NVIDIA GPUs, backed by hyperscale class CPUs, exabyte scale storage, and high-speed networking and interconnects for AI workloads. But here too, the conditions matter. If SpaceX does not deliver the committed GPUs by September 30th, after a 1-month grace period, Google can terminate the agreement or accept partial capacity at a proportionally reduced fee. After December 31st, 2026, either party may terminate on 90 days' notice. So the Google agreement strengthens the AI revenue story. It also strengthens the proof gate question. Can SpaceX deliver the capacity, keep the customers, and turn compute demand into profitable infrastructure economics? Does the revenue show up? Does capacity utilization improve? Does the AI segment move toward profitability? Does CapEx slow down? Or does AI keep consuming capital faster than the rest of the business can produce it? That is the AI proof gate. Now, let us address the rumors and flow theories because they are everywhere on an IPO like this. First, QQQ. QQQ tracks the NASDAQ 100. SPCX is listed on NASDAQ. SPCX is huge. So the obvious question is, does this get forced into QQQ? The answer is not today. It is also not impossible. The NASDAQ 100 methodology has a fast entry path. A security that is not already in the index may be added on an expedited basis if its full market capitalization ranks within the top 40 current index constituents, and it satisfies the other security eligibility criteria. For a new IPO, the company is evaluated at the end of its 7th trading day on an eligible exchange. The methodology says such a security is typically added after 15 trading days, with an announcement after the close of its 10th trading day. So here's the clean way to say it. QQQ inclusion is a possible future catalyst. It is not a day one fact. It is not guaranteed. And investors should not assume every first-day buyer is an index fund. If SPCX qualifies and NASDAQ announces a fast entry edition, then NASDAQ 100 tracking funds may need to buy around the effective date. That could create mechanical demand. But until the announcement exists, it is a watch item, not a fact. This is exactly the kind of thing that can create hype before it creates evidence. But do not confuse NASDAQ 100 with the S&P 500. Those are different index families with different processes. NASDAQ fast entry is possible under NASDAQ's own methodology. That does not mean the S&P 500 has fast-tracked SPCX. In fact, S&P Dow Jones Indices announced in June that it would not change key eligibility criteria such as financial viability screens, seasoning period, or minimum investable weight factor solely because a company is mega cap. As of this script, I have not seen an official S&P 500 inclusion announcement for SpaceX. So the clean distinction is NASDAQ 100 fast entry is a live watch item. S&P 500 inclusion is not a verified near-term fact. And index speculation is not business proof. There is also a political layer around this. Reuters reported criticism from lawmakers around rapid index inclusion and retirement portfolio exposure. That is not proof of a conspiracy. It is a reminder that when a $2 trillion controlled company enters public markets, index rules can become political. The bigger the company, the more mechanical ownership questions matter. That is especially true if ordinary retirement savers end up owning the stock through index products without making an individual stock decision. Now, the Fidelity and 401k question, the prospectus does mention Fidelity, but it mentions Fidelity in a specific way. It says certain shares may be offered to retail investors through Charles Schwab, Fidelity Brokerage Services, and Fidelity Capital Markets, Robinhood, SoFi Securities, and E-Trade by Morgan Stanley as online brokerage platforms. That is retail IPO distribution. That is not the same as a forced 401k purchase. A 401k plan normally gives participants access to funds selected by the plan. Those funds buy securities according to their mandate. An index fund buys what its index requires. An active fund buys what the manager chooses. A target date fund owns underlying funds according to an allocation. That is very different from saying Fidelity 401k investors were forced to buy SPCX on IPO day. I do not see source-backed evidence for that forced buy claim. What I do see is a real distribution fact. Fidelity-related brokerage channels were listed among platforms that could offer IPO shares to retail investors. And I see a real future flow question. If SPCX later enters the NASDAQ 100 or other major benchmarks, index-linked funds may have to own it. That is the legitimate version of the flow thesis. Everything else needs evidence. One more near-term catalyst belongs here. Options. Reuters reported that SPCX options were expected to begin trading as soon as Tuesday, with heavy activity expected. That matters because options can amplify volatility. They can make it easier for traders to buy upside calls, hedge downside risk, sell premium, and create large short-term positioning around a brand new stock. Options do not change SpaceX's business. They do not make Starlink more profitable. They do not make Starship work faster. But they can change the stock's trading behavior. So if next week looks even more volatile than IPO day, options may be part of the reason. Now, the political or conspiracy angle, this is where we have to be precise. If by political angle, someone means a hidden conspiracy where the IPO is being forced into retirement accounts or secretly propped up by government actors, I do not see evidence for that in the sources. I would not put that in the script as a claim. But if by political angle, someone means government dependence, procurement, national security, spectrum, defense, export controls, and regulatory power, then yes, that angle is absolutely real. The final prospectus says approximately 1/5 of 2025 revenue was attributable to agencies within the U.S. federal government. The company says it is subject to federal procurement rules, including FAR and DFARS, plus rules covering cost accounting, cybersecurity, ethics, and national security. It also says government contracts can be terminated, reduced, delayed, or changed because of shifting budget priorities, defense or space policy, or reallocation of funding. That is a political risk. The filing also talks about FAA launch and re-entry approvals. It talks about FCC and international spectrum authorizations for Starlink and Starlink Mobile. It talks about public interest and national security reviews. It talks about sanctions, export controls, tariffs, import regulations, and geopolitical conditions. And it says some governments or customers may hesitate to rely on satellite connectivity or defense-related services if they believe availability could be restricted or suspended based on geopolitical considerations, conflicts, sanctions, or policy decisions. That is the real political angle, not a cartoon conspiracy. A public company whose products are strategically important can become more valuable because governments need it. It can also become more vulnerable because governments can regulate it, fund it, delay it, restrict it, or use it as a symbol. SPCX sits directly in that tension. Now let us frame the bull case. The bull case is not just rockets are cool. The real bull case is that SpaceX may own the low-cost infrastructure layer for the space economy. If you control launch cadence and launch cost, you can deploy your own network faster than competitors. If your own network is Starlink, you can create a recurring connectivity business that reaches consumers, enterprises, ships, aircraft, rural areas, military users, and mobile devices. If Starlink scales, it can fund more launch, more satellites, and more network capacity. If Starship works, the cost curve can bend again. If AI compute becomes power constrained on Earth, SpaceX can argue that its launch capability, satellite manufacturing, solar access, and Starlink network give it a unique path to orbital compute. If governments continue to rely on SpaceX for launch and connectivity, that creates strategic durability that normal commercial companies do not have. And if SPCX enters major indexes, passive demand could broaden the shareholder base. That is the bull case in one sentence. SPCX is a vertically integrated infrastructure platform where launch enables connectivity, connectivity produces cash flow, government demand creates strategic durability, and AI adds massive optionality. That is a serious thesis, but the bear case is serious too. The bear case starts with valuation. At the IPO price, the company was already valued around $1.8 trillion on the post-offering share count. At the first day quote, around $161, the market cap was above $2 trillion. That is a huge valuation for a company with $18.7 billion of 2025 revenue and a $4.9 billion net loss. Said another way, the market is already pricing a lot of tomorrow into today's stock. Even if you focus on adjusted EBITDA, the valuation is still pricing a long runway of future dominance. That might be right, but it leaves less room for disappointment. The second bear case is CapEx. $20.7 billion of CapEx in 2025. $10.1 billion in the first quarter of 2026. That is not a normal maintenance budget. That is a company trying to build the future in multiple capital-intensive markets at once. If that spending creates durable revenue and cash flow, it can be brilliant. If it runs ahead of demand, it can destroy per-share value. The third bear case is AI. The AI story may be the biggest upside option. It is also the biggest financial swing factor. The segment is generating revenue, but it is losing billions and spending billions. Investors have to ask whether AI turns into a high-return infrastructure business or becomes a capital sink attached to a great space company. The fourth bear case is Starship. So much of the future story depends on Starship scaling. Next generation Starlink satellites, satellite to mobile expansion, orbital AI compute, Mars, higher launch cadence, lower cost. The more the thesis depends on Starship, the more delays matter. The fifth bear case is governance. Class A shareholders have 1 vote per share. Class B shareholders have 10. Elon Musk is expected to have more than 80% of the voting power. For some investors, that is a feature. For others, it is a risk. But either way, public investors are not buying control. They are buying economic exposure to a controlled company. The sixth bear case is future dilution and supply. The public float is limited today, but the prospectus includes a lot of future share supply mechanics. Restricted shares can become available over time. Lockup releases matter. The first earnings release can trigger early release conditions if the stock is at least 30% above the IPO price for certain trading days. Additional releases are scheduled around 70, 90, 105, 120, 135, and 180 days after the prospectus date. The prospectus also notes potential share issuance tied to the EchoStar spectrum transaction and a possible Cursor acquisition option. So day one float scarcity is real. But float scarcity is not permanent. That is why I would not look only at the first day candle. I would look at the future supply calendar. Now, what should investors watch after the IPO? This is the proof gate section. Proof gate number 1, the first public earnings report. The IPO gave investors historical numbers through the first quarter of 2026. The first post-IPO report will show how the business behaves as a public company. The market will want revenue growth, segment margins, operating cash flow, CapEx, and management commentary. Proof gate number 2, Starlink subscriber growth plus ARPU. Do not accept subscriber growth alone. The real question is whether Starlink can keep expanding while stabilizing ARPU and protecting segment profit. If subscribers grow, but ARPU keeps falling too fast, the market may start questioning the quality of growth. If subscribers grow, ARPU stabilizes and segment margin stays strong, that is powerful evidence for the bull case. Proof gate number 3, Starship cadence. The prospectus makes Starship central to the future. So investors should watch development milestones, launch cadence, regulatory approvals, V3 satellite deployment, reusability, turnaround time, and cost per kilogram. Starship does not need to prove Mars tomorrow, but it does need to prove that it can unlock the next step in Starlink, mobile connectivity, and AI infrastructure. Proof gate number 4, AI revenue quality. The Anthropic agreement is a major headline, but the proof is whether AI revenue is recognized, whether capacity is used, whether customers renew or expand, whether CapEx slows relative to revenue, and whether AI segment losses narrow. If AI keeps consuming capital without operating leverage, it can weigh on the whole thesis. If AI starts turning massive infrastructure spend into sticky revenue, it can change the company. Proof gate number 5, free cash flow after CapEx. Operating cash flow is not enough. A company spending more than $20 billion a year in CapEx has to be judged after investment needs. The question is not only, can SpaceX generate cash from operations? The better question is, can SpaceX fund its ambitions without constantly relying on external capital? Proof gate number 6, government and regulatory risk. Watch NASA. Watch national security launch. Watch FAA launch approvals. Watch FCC spectrum approvals. Watch international Starlink approvals. Watch sanctions, export controls, and geopolitical disputes. This is not a side issue. It is part of the business model. Proof gate number 7, index eligibility. If SPCX remains large enough and meets NASDAQ 100 requirements, a fast entry announcement could matter. But until NASDAQ announces it, do not treat it as a completed catalyst. The timeline to watch is the 7th trading day evaluation, the 10th trading day announcement window, and the typical 15 trading day addition path. And keep the index families separate. NASDAQ 100 is one question. The S&P 500 is another. Neither should be treated as proof until the index provider announces it. Proof gate number 8, options and short-term volatility. Watch when listed options begin trading how expensive implied volatility is, where call volume concentrates and whether options positioning starts driving the stock instead of the other way around. This is a trading proof gate, not a business proof gate. It can explain volatility. It cannot validate valuation. Proof gate number 9, lockup and supply releases. The first day float is not the future float. Watch the first earnings release conditions and the calendar-based releases. When supply increases, the market gets a cleaner test of whether demand is durable. Proof gate number 10, per share value. This is the final gate. The company can be important and still disappoint public shareholders if dilution, CapEx, governance, and valuation absorb too much of the upside. The question is not only whether SpaceX changes the world, the question is whether Class A shareholders participate in that value at the price they paid. That is the difference between a great company and a great stock. So here is the bottom line. SPCX may be the most important IPO in years. It may also be one of the hardest IPOs to value, honestly. The business has real proof. Starlink is real. Launch dominance is real. Government demand is real. Revenue scale is real. Operating cash flow is real, but the risks are also real. Net losses are real. CapEx is real. AI uncertainty is real. Starship execution risk is real. Political and regulatory exposure is real. Governance concentration is real. And day one hype is real. That combination is why SPCX belongs in the proof box, not the mythology box. The bull case says this is the infrastructure layer of the next economy. The bear case says the stock already prices in too much of that future before the public market has seen enough quarterly proof. Both sides have evidence. That is what makes the stock interesting. If you are watching SPCX after this IPO, do not only ask where the stock opened. Ask what the next filing proves. Does Starlink keep compounding? Does ARPU stabilize? Does Starship unlock capacity? Does AI become a business instead of a spending line? Does free cash flow appear after CapEx? Does NASDAQ announce index inclusion? Do lockup releases change supply? And does the company turn strategic importance into per share value? That is the real SPCX story. Not just rockets, not just Mars, not just Elon, not just QQQ, not just first day hype. The real story is whether one of the most ambitious companies in the world can become one of the best public investments in the world at a price that already assumes it is extraordinary.